Is a handmade Hermès bag a better long-term investment than its stock? Welcome to the Valuation Masterclass case study, where you'll learn about interesting stocks and how to value them. What's interesting about Hermès is that it is still owned by the family, now in its sixth generation. This is Andrew Stotz of the Valuation Masterclass. Let's get started. This information is for learning purposes only. This is not investment advice or a recommendation. So Hermès is one of the most famous French companies in the consumer discretionary sector. It's been family controlled for 185 years, and it's a luxury manufacturer specialized in leather goods and lifestyle accessories. This is an interesting company. I'm going to switch over. I was on their website and I was just looking at sustainability, and I give a lot of grief to ESG, and I think that there's a lot of ESG which is a scam. But what I thought about them that I found interesting, I took this from their website. And the first is they talked about sustainability of the objects. They say repair workshops preserve the sustainability of these objects, meaning the bags and the like, so that they're passed on from one owner to the next. That's true sustainability. That's pretty interesting. They also talk about sustainability in employment and say to support its growth, they create jobs each year and they're committed to training their artisans. What they call sustainability related to local anchoring. With more than 51 production sites, Hermès is present in 12 of the 13 French regions. This is a truly French company. 80% of the objects are manufactured there, including 100% of leather goods. The company contributes to the active revitalization of these territories. The logical establishment of factories in regional hubs allows employees to become part of a local social and cultural ecosystem. And partnerships. Hermès is very loyal to its industrial suppliers and has been so for more than 20 years on average for its 50 main direct suppliers. So 50 main direct suppliers have been working with them for 20 years. That's sustainability. And finally, when they talk about natural resources, what they say is that our product comes from natural resources, and they try to control water, energy consumption, and carbon footprint. I particularly like this particular discussion about its sustainability. I feel like that's the type of sustainability discussion I want to hear. So there's three things that you need to know about this company. First, the competitive moat allows for sustainable high margins. Number two is intended scarcity creates excess demand. Number three, Asia is a vital market for luxury brands to realize growth. So some key statistics. There's 19 companies or 19 individuals, analysts covering the company. They've got a euro 1,300 target price, which is about a 14% upside or a buy. The PE ratio is about 45 times. That's not cheap. And the dividend yield is 0.7%. That's very low. My estimate, 811, that's a downside of 29%, which would make it a sell if I was recommending it, which I'm not. So let's get into this. Let's look at the revenue. Leather goods and saddlery count for almost 50% of the business. Ready-to-wear accessories, 25%. And silk, textiles, beauty, watches, and others, 29%. 47% of its business comes from Asia, and that's Asia ex Japan, because you can see that Japan's separated out, and that's 11% of revenue by region. So Asia is the place. So let's look at the story. Here you can see the competitive moat allows for sustainable high margins. And Hermès has consistently delivered a massive gross margin over time. The average for its industry, consumer discretionary, is 27% gross margin, and the Hermès 3 years average is almost a 70% gross profit margin. That is an unbeatable moat. it's almost 3 times higher than its sector. Now, the company follows a differentiation strategy, and they've developed a vision of developing high-quality products. You can see their focus on craftsmanship, excellence, quality, precision, savoir-faire. I probably pronounced that pretty terribly, but that's my... And it only manufactures its products in France. Hermès can operate in price categories where customer sensitivity is relatively low. So part of the reason why the share price has done reasonably well is because people think, well, in a downturn, the rich don't get affected as much, and so they still want their bags. Its luxury collections provide high sustainable margins with high pricing power. Intended scarcity creates excess demand. Yes, that's intended scarcity. Think about all the companies trying to sell as many products as possible. But Hermès operates only 300 stores globally, which is less than in the past. It's actually been reducing or flat. That is fascinating. And that is how they create scarcity. For comparison, Louis Vuitton LVMH has more than 5,500 stores. Exclusivity and difficult access to its products make the brand so desirable. I just walked past the store, and what I could see the other day was that it is basically a lineup of people outside. It creates the intended scarcity and has long waiting lists of several years for its bags. The higher the price, the higher the demand. Now, let's look at increasing price to increase demand. Sounds very odd. Let's see what we can understand about this. The first thing is, for the majority of goods, somebody said they couldn't see the screen, so I'll just make sure that hopefully you're seeing the screen. Raising the price helps keep this exclusivity. Now, low marketing costs compared to competitors. Unlike its competitors, basically it has a much lower SG&A and marketing costs as a percent of revenue. And that's really because they don't need it. The scarcity does the marketing for them. The difference is Hermès doesn't rely on brand ambassadors or celebrities promoting the brand. For its competitors, such ambassadors are the key for marketing, but also very expensive. Now, number 3 is Asia is a vital market for luxury brands to realize growth. Between 2010 and 2021, revenue from Asia has increased 5 times. That is incredible, and this chart shows it. In 2021, it's been enormous. Its home market, Europe, only increased 2 times over the same horizon. Luxury products in Asia are a representation of high status, and craftsmanship and artistry are widely associated with the upper class here in Asia. It's the main market for Hermès to focus on to continue realizing growth. So let's look at the forecast. Right now, consensus is somewhat divided. There's 19 analysts, and we can see a 43% upside. The majority of analysts stay as a hold, as the current share price might be too high. Analysts predict strong margins to continue for Hermès and pricing power continues to be strong. But they do expect that revenue growth is going to come down in 2023 and 2024. So let's go through some of my financials that I've looked at. Net profit could stay at these heightened levels as its record strong demand growth for its products. The balance sheet, Hermès has a strong cash position as it generates huge cash flows. So we're talking about nearly 50% of the balance sheet, of the assets on the balance sheet, are cash. Liabilities, well, Hermès has low leverage with a liabilities to equity ratio of 30%. And a strong bottom line. Keep in mind, there's no debt. So equity is really the main financing, and yet they can still maintain a 20 to 30% net profit margin. Now, return on invested capital is much higher than that because of the fact that it's got so much cash. The cash conversion cycle is very long, but it's not a risk given the strong cash position and cash flow generation ability. If you want to learn how to value companies like this, join my 6-week online valuation masterclass bootcamp. Learn practical valuation skills by valuing actual companies. Access all my tools, tips, and tricks. Join a group of inspiring financial professionals. Get a job through my network of financial industry leaders. The next bootcamp, well, the next one starts on July 25th, and I hope to see you there. After that, October 10th and January 9th. You can join for just $797. Just scan this QR code or go to valuationmasterclass.com/bootcamp to learn more. Let's talk about valuation. CapEx requirements are relatively low as it does not expand aggressively into physical stores. So we can see it's quite small, about a half a billion euros that they're spending on CapEx. And what that ultimately means is free cash flow of the firm is very strong. So here we can see that I'm a bit more cautious about the revenue growth prospects as China's demand could be lower. I'm forecasting 9.9% over the next 3 years, whereas consensus is at 12%. I'm holding margins pretty still, particularly net margin. I value the company by using the free cash flow of the firm and a terminal growth rate of 4%, which you could say is a little bit high. And that gives me a cost of equity of 7.8% and a weighted average cost of capital of 7.3%. So what do we end up with? A downside of 29%. The bull case is 23%, and a bear case is 33%. You can see it's not in a very wide range because the stability of this company. So what are the risks? Well, failure to adapt to changing consumer demands, mean reversion of temporary heightened margin. That one's interesting. If the margin ever started to compress, it would be pretty amazing. But this is an example of a company that's maintained its moat for many years. And failure to comply with growing ESG standards could lead to reputational damage. But I think the ESG aspect, they probably got undercover. Conclusion. Competitive moat delivers best-in-class margin. Asia continues to provide ample growth opportunities and lucrative company, but at an expensive price. So let me ask you, is a handmade Hermès bag a better long-term investment than its stock? Let me know in the comments below your ideas, your thoughts. And I bet as far as an investment's concerned, if you're a man, to keep your wife happy, it may be a great investment to buy a Hermès.